Welcome to the Deep Dive, where we break down the critical intelligence from corporate earnings calls and give you the summary you need.
And today, we're getting into one from Lucky Strike Entertainment Corp, ticker LUCK.
That's right, their Q1 Fiscal 26 earnings. And this one, it's a really interesting story.
It really is, because this deep dive, it kicks off with a classic conundrum for investors. The company delivered a solid beat. A really solid beat.
Yeah, they beat on top-line revenue and on their adjusted earnings.
But despite those strong numbers, the stock, well, it saw a modest decline in after-hours trading. It just kind of drifted lower the next day.
So it's a classic trade-off narrative. Scale is working, but maybe the core business has a bit of a pulse problem.
Exactly.
Okay, so let's unpack that tension. The report dropped after market close on November 4th, 2025. Let's establish those headline numbers first.
All right, starting with that scale you mentioned. Total revenue hit $292.3 million.
And that beat the consensus forecast by about, what, $10 million?
Just about. $9.9 million. And it represents a pretty powerful 12.3% growth year over year.
Okay, and what about profitability?
Adjusted EBITDA, which is, the company's favored metric here, was also strong. It climbed 15% year over year to $72.7 million.
Which gives them a margin of almost 25%.
A robust 24.9% margin, yeah.
And on the bottom line, they also beat a narrower than expected net loss. Adjusted EPS came in at negative 12 cents.
Right, which beat the consensus expectation of negative 15 cents. So on the surface, everything looks good.
So if all the adjusted growth metrics are solid, and they're beating analyst estimates, what caused that immediate skepticism from the market?
Well, what's fascinating here is how the market just, it discounted those strong adjusted metrics almost immediately.
He looks right past them.
They did, because they were focused on the true underlying health of the business. And two numbers really worried people.
Okay.
First, the actual loss under GAAP, generally accepted accounting principles, it was $13.8 million.
And that's driven by what? High interest expense?
Yeah, primarily high interest expense and transaction costs. It's all related to their huge M&A push, which we have to get into.
Okay, and the second, and I'm guessing more crucial, sticking point.
It was the metric everyone uses for retail and leisure operators. Same store revenue, SSS.
Right, the one that strips out the new openings and acquisitions to see how the core business is doing.
And that metric was essentially flat. It came in at negative 0.4% year over year.
Oof.
And that's what the market focused on, that underlying softness. They basically concluded that all the scale and efficiency gains were just masking a core organic slowdown.
That sets the stage perfectly. So the growth isn't organic, not yet anyway. It's being driven by smart but inorganic capital allocation.
Right.
So let's unpack this. Management is executing a clear dual strategy. Scale aggressively with M&A and at the same time shore up the balance sheet. Let's look at that scale first.
LECK is just, they are the ultimate platform consolidator in this space. They expanded their footprint to 369 locations this quarter.
Adding 5 new sites.
5 sites. But critically, these weren't just more bowling centers. The additions included the acquisition of 2 large, profitable water parks.
Right. Raging Waters LA and Wet Wild Emerald Point in North Carolina.
Exactly. Plus, they added 3 really high-performing family entertainment centers, FECs, in Southern California.
So that's a $90 million transaction designed to drive high returns, especially when they cycle into the summer season.
It shows they're thinking strategically beyond the current quarter. They're buying these high-margin assets, diversifying away from just bowling.
It's a smart move.
It is. They're buying assets where they see immediate accretion. But, the most intriguing capital move this quarter was the massive push into real estate.
Oh yeah, the $306 million acquisition of 58 existing sites they used to lease.
That is a fundamental shift in strategy.
It really is. They're moving away from that popular asset-light model where you rent toward becoming an asset-heavy owner. So what's the strategic significance there?
Well, management framed this as a long-term flexibility move. Owning these sites does a couple of things.
Okay.
First, it immediately lowers their exposure to unpredictable rent hikes in the future. But more importantly, it sets them up for future accretive financial opportunities.
Meaning they can use the properties as collateral.
Exactly. These owned assets can be used for a favorable refinancing Or, and this is key, they can execute future sale leaseback transactions.
Where they sell the property but lease it back immediately.
Right, which can rapidly inject hundreds of millions of dollars back into the company. It's a way of turning latent asset value into immediate operating cash.
That feels very intentional. And speaking of the balance sheet, they also tackled their debt structure this quarter, right?
They did. They successfully closed a crucial refinancing in September. They secured a new $1.2 billion term loan and $500 million in secured notes at 7.25%.
And that was a masterstroke for giving them runway.
A huge one. It extends their debt maturities way out to 2032 and even trimmed the term loan rate a little bit by 25 basis points.
So by pushing that debt out 8 years to 2032, are they basically buying themselves this massive, stress-free window to get the operational overhaul done?
That is precisely the implication. It provides stability. And, maybe the clearest signal of management's confidence in all this was the dividend.
Right. Despite the GAAP loss, they raised it.
Despite the GAAP loss, the board raised the quarterly dividend by about 9% to 6 cents. That speaks volumes about their belief in future free cash flow generation.
They're spending a lot of money, but they're still confident enough to reward shareholders now.
Exactly.
So if we connect this to the bigger picture, it seems like management is prioritizing this inorganic scale for now, but they've signaled the focus has to shift back to fixing the organic core.
And that shift is supported by their CapEx discipline. Capital expenditures were only $26 million this quarter, which is way down from $42 million a year ago.
So they're saying the major spending is done, and now it's about optimization.
That's the signal. Full-year CapEx is tracking below their guidance. The focus now is on optimizing what they already own.
Which takes us right to the heart of the matter. This is where it gets really important. How do they actually plan to fix that negative same-store sales number?
It's all about the turnaround efforts happening inside the existing locations, specifically F&B optimization and the big brand conversion.
Let's start with the brand conversion.
It's essential for their operational efficiency. LUCK is operating under too many different brand names, which, it dilutes your marketing spend.
Right.
So they converted 74 locations to the unified Lucky Strike brand this quarter. They're on track to hit 100 by the end of this calendar year and 200 by the end of fiscal 26.
And consolidating down to just two main brands, AMF and Lucky Strike, that has to help the marketing budget.
Tremendously. And that conversion is clearly driving F&B attachment, which is where the real margin is.
Food sales were up 10% in the quarter. Yeah. And management was clear, this wasn't just inflation.
Not at all. The growth was entirely driven by increased attachment, so more customers buying food and higher volume. That's a powerful thing in this environment.
And they're executing on specific menu items with incredible speed.
Astonishing speed. They highlighted their new pizza and pitcher combo, drove over $8.5 million in sales in just 5 months.
That's just smart, simple pricing.
It is. And then these new platters they designed for larger groups generated another $1.3 million in just 3 months. That's rapid, focused execution.
And you can't overlook the League customer turnaround. League revenue itself was up 2.1%.
And October was up over 5%. But historically, leagues were seen as, a necessary evil. They brought people in, but they were terrible for F&B profit.
That legacy mindset is clearly gone.
It's gone. Management made a few changes, better staffing on league nights, dedicated menus optimized for quick service. And the result is staggering.
What was it?
5 consecutive weeks of all-time high food and beverage revenue coming specifically from league bowlers. They've turned their low-margin customers into consistent revenue generators.
So that raises the big question.
Yeah.
What is the true long-term upside of this F&B transformation? How big can this get?
I mean, the numbers they shared are absolutely eye-opening. Lucky Strike branded locations currently have a 50% higher ratio of F&B to bowling revenue compared to the legacy AMF and Bolero spots.
50% higher.
50%. So if LUCK can normalize that gap across the entire system, if they get the old centers to perform like the new ones, that's a potential annual revenue pickup of $125 million to $150 million.
That's the massive hidden organic growth engine they're building right now.
That's it.
Okay, if that's the upside, we have to go back to that short-term drag, the negative 0.4% SSS. If F&B is up and league revenue is up, What was the headwind that kept the number negative?
The anchor dragging down the results was the corporate events business.
Okay.
Corporate events were down 11% in the quarter, which caused a huge 160 basis point drag on total comps.
But this wasn't a national trend, was it?
No, and that's the key point. Management attributed the weakness primarily to geographical concentration, specifically California and Washington state. They cited the massive sustained layoffs in Silicon Valley and the tech sectors.
So this is a regional tech-centric problem, not a leisure-wide problem.
Precisely. And management was quick to point out that if you strip out those two weak regions, the company would have comped up in the low single digits, firmly positive.
And the rest of the country was strong.
Yeah, places like New York, Texas, Florida, they saw strong event bookings. And importantly, they are seeing signs of recovery. October was their strongest month for events in over a year and a half.
Which gives them some confidence heading into the holidays.
A lot of confidence.
Okay, diving into the outlook, management clearly wants to reassure the street. They reaffirmed their full-year fiscal 26 guidance.
They did. Revenue targets are still $1.26 to $1.31 billion, and adjusted EBITDA is still $375 to $415 million.
And that reaffirmation signals they are extremely confident that this organic growth engine will turn positive.
They're holding their SSS guidance for the full year at 1% to 5%. They expect Q2 and Q3 to fall right in that range, with Q4 being, I think the quote was, a little bit better.
And for the margin watchers, they confirmed Q1 is seasonally their lowest. We should expect a big jump in the winter quarters.
A huge jump. 600 to 800 basis points of margin improvement, that's 6 to 8 percentage points, before it cycles back down in the June quarter.
They also noted an interesting macro trend about promotions.
Yeah, that was interesting. They observed a slowdown in aggressive promotional activity from their competitors. They see the environment as easing up, moving away from a race to the bottom.
Which benefits them. They can be more tactical with their own holiday pricing without just killing their margins.
Exactly.
So what does this all mean for the equity? The stock performance has seriously lagged the sector. It feels like the market has just written them off.
Well, the path to re-rating the stock really requires two things. First, they have to deliver sustained same-store sales stabilization. That corporate events business has to recover.
That's number one.
And second, an inflection in free cash flow as all these new assets and converted sites mature, which, management says takes a full 12 to 18 months.
So the trade-off is clear. You're buying double-digit EBITDA growth today, but you have to wait for that core organic business to catch up.
That's the story.
Okay, now we move to our segment. This is not financial advice. We turn to the wildest yet still plausible trade idea we could pull from the call.
All right. So for this one, I am pitching a highly leveraged long-term asset value realization play.
Yep.
The stock is currently trading around, $8.19. It's seemingly trapped by this near-term SSS anxiety and the interest expense. The market is completely ignoring the implied asset value in that real estate push.
That $306 million acquisition of 58 sites.
The market is assigning it almost zero value.
So the thesis isn't about the F&B turnaround, but the hidden value of the land and buildings. How do you play that?
The trade is a highly directional bet on a sudden, massive corporate event. You short the common stock to capitalize on any continued SSS weakness and the high leverage.
Okay, so you're betting against it.
But you hedge that short by purchasing long-dated, deep out-of-the-money calls, say a $15 strike, 18 months out.
So it's a kind of synthetic long on a big corporate event.
Exactly. You're betting on a large-scale sale-leaseback transaction within the next 18 months. Management explicitly flagged it as a possibility.
What if they do that?
If they execute, say, a $200 million sale-leaseback, that capital could be used to rapidly reduce debt, fund a huge stock buyback, or it makes LUCK an immediate LBO target.
A leveraged buyout based on the asset strip value.
And the fact that the stock only fell about 1.1% post-call tells you the immediate downside risk is pretty limited. The valuation is a cheap entry point for a massive catalyst.
That is certainly a move for a patient and maybe adventurous investor.
You're positioning for the eventual realization of that asset value.
Okay, to wrap up our deep dive, Lucky Strike is successfully delivering scale-driven growth with adjusted EBITDA up a strong 15%. They're managing the balance sheet through M&A and this huge real estate push.
However, they remain absolutely reliant on two key internal factors: a robust recovery in corporate events, especially normalizing that drag from California and Washington,
and the continued successful execution of that very impressive F&B program to finally stabilize same-store sales.
They have to deliver on those organic growth targets.
So Given that the stock is lagging the broader leisure sector so much, how long can the market afford to ignore double-digit EBITDA growth and that massive, 125 to $150 million annual revenue potential from F&B?
Especially if that corporate event business begins to normalize over the next 2 quarters and management starts to signal they're ready to monetize that new $306 million real estate portfolio. That's the question you have to answer.